Our topic for today is all about Ponzi scheme and other pyramid schemes under economic crimes. Scope of presentation: overview on economic crime, investment frauds, Ponzi scheme, pyramid schemes, and tips on avoiding schemes. Economic crime, also known as financial crime, refers to illegal acts committed by an individual or a group of individuals to obtain a financial or professional advantage. The principal motive in such crime is financial gain. So let us talk about investment fraud as one of the crime areas under economic crimes. Investment fraud relies on social engineering techniques, which is the use of deception to manipulate individuals into divulging confidential or personal information that may be used for fraudulent purposes, which makes it particularly hard to counter. It can't be denied that many are victims of investment fraud. Now let's look into common frauds that some people are attracted to or engaged to. The first is the Ponzi scheme. Ponzi scheme is a fraudulent investing scam promising high rates of return with little risk to investors. It generates returns for early investors by acquiring new investors. Usually, companies that engage in a Ponzi scheme focus all of their energy into attracting new clients to make investments. Ponzi schemes rely on a constant flow of new investments to continue to provide returns to all their investments. To attract more victims, the fraudsters will start to repay the initial investors using funds accrued from additional investors. The term Ponzi scheme was coined after a swindler named Charles Ponzi in 1919. Charles Ponzi scheme focused on U.S. Postal Service. The Postal Service at that time had developed international coupons that allowed a sender to pre-purchase and include it in their correspondence. The receiver would take the coupon to a local post office and exchange it for the priority airmail postage stamps needed to send a reply. Under the heading of this company, he promised returns of 50% in 45 days or 100% in 90 days. Due to his success in the postage stamp schemes, investors were immediately attracted. Instead of actually investing the money, Ponzi just redistributed it and told the investors they made a profit. So that is Ponzi scheme. Now let us move on to the pyramid scheme. Actually, pyramid schemes and Ponzi schemes share similar characteristics. First, a guaranteed promise of high returns with little risk. Second, a consistent flow of returns regardless of market conditions. Third, investments that have not been registered with the Securities and Exchange Commission. Fourth, investment strategies that are secret or described as too complex to explain. And fifth, clients facing difficulties in retrieving or in removing their money. Now, as in Ponzi schemes, the money collected from newer victims of pyramid schemes is paid to earlier victims to provide winner legitimacy. However, in pyramid schemes, the victims themselves are indicted to recruit further victims through the pyramid of recruitment commissions. More specifically, pyramid schemes, also referred to as franchise fraud or chain referral schemes, are marketing and investment frauds in which an individual is offered a distributorship or franchise to market a particular product. The real profit is earned not by the sale of the products but by the sale of the distributorship. Before we dig deeper on the pyramid schemes, let us take some few key takeaways for both pyramid scheme and Ponzi scheme. Both pyramid scheme and Ponzi scheme involve the unscrupulous investors taking advantage of unsuspected individuals by promising them extraordinary returns in exchange for their money. With Ponzi schemes, the investors give money to a portfolio manager. Then when they want their money back, they are paid out by the incoming funds contributed by later investors. With a pyramid scheme, the initial schemer recruits other investors who in turn recruit other investors and so on. Late joining investors pay the person who recruited them for the right to participate or perhaps sell a certain product. Pyramid scheme is a sketchy and unsustainable business model where a few to a level members recruit new members who pay upfront costs up to the chain to those who enrolled them. As new members recruit new underlings of their own, a portion of the subsequent fees they receive is also kicked up the chain. It is understandable that consumers often have the difficulty telling the difference between an illegal pyramid scheme and a legitimate multi-level marketing opportunity. Before we proceed on the discussion on the forms and how pyramid schemes works, let us first talk about the difference between multi-level marketing and pyramid scheme. Multi-level marketing or network marketing is a form of business that uses independent representatives to sell products or services to family, friends, and acquaintances. A representative earns commissions from retail sales he or she makes and also from retail sales made by other people that he or she recruits. Multi-level marketing is a legal business practice that involves the sale of actual goods or services, but participants are not mandated to close any sales in order to generate income by recruiting members below them. On the other side, pyramid schemes claim to be in the business of selling products to consumers in order to look like a multi-level marketing company. They make virtually all their profits from signing up new recruits and often attempt to disguise entry fees as the price charged for mandatory purchases of training, computer services, or product inventory. Because the pyramid schemes rely on the recruitment of new members to bring in money, the schemes often collapses when the pool of potential recruits dries up. This is what we call the market saturation, which happens when a specific market no longer demands a products or services or when the entire market has no new demand. Now, how does pyramid scheme works? Pyramid schemes are so named because they resemble a pyramid structure starting with a single point on top that becomes progressively wider toward the bottom. Let us take this for example. Founder Y sits alone at the top, represented by the number 1. Assume Mr. Y recruits 10 people to the level directly below him, where each person must issue him a cash payment for the privilege of joining. Not only the money goes directly into Mr. Y's pocket, but each of the 10 new members must then recruit 10 members of their own, totaling to 100 people, who must pay fees to the tier 2 recruiters who must then send a percentage of their takes back up to Mr. Y. It should be noted that because pyramid schemes heavily rely on fees from new recruits, the vast majority do not involve the sale of actual products or services with intrinsic value. Now let us move on to the different types of pyramid schemes. First is the chain letters or emails. This involves the sending of money or gifts to a person on a top list while you add your name to the bottom. These are another form of pyramid selling and are illegal. Usually a letter or email will ask you to send a small amount of money to everyone listed in the letter. You put your name at the bottom of the list and send out copies of the letter to as many people as you can. The letter claims you will receive a large amount of money in a short space of time. This rarely happens. A letter email you receive may have these warning signs. Promise you money or good luck if you copy it and send it to a number of other people, suggest that you will have bad luck if you don't or lose out on a fantastic opportunity, or include a token amount as a demonstration of good faith, such as 5 cents, and recommend you to send the same in your letters, or it contains claims it is not a scam or a pyramid scheme, or it contains testimonies from people who claim to have made a fortune by taking part. Now, another types of pyramid scheme is what we call cash gifting. Cash gifting schemes are the quintessential example of a pyramid scheme. Instead of selling products, cash gifting schemes forego the sale of products and just give people cash. But the premise is the same, just like other pyramid schemes. Cash gifting schemes are based on the amount of people recruited. Generally, these gifting circles, clubs, or groups encourages participants to pay a substantial entry fee, which can range anywhere from 500 or more. These entry fees guarantee the participants a place on a chart of members. The participants will move on the chart every time they recruit more people into the circle or club. And once the participant moves enough on the chart, they are guaranteed a large payout. Gifting schemes operates under a variety of names, as con artists that start these schemes endlessly creative in their quest to con a lot of people out of a lot of money. Moving on, the multi-level marketing pyramid schemes. These multi-level marketing pyramid schemes are nearly indistinguishable from pyramid scheme because they involve the sale of printed materials that have no real value, such as educational courses. These multi-level marketing pyramid schemes thrive by forcing recruits to buy such no-value products at high costs and by making them sell these same products to next generational members. Pyramid schemes and Ponzi schemes have many similar characteristics based around the same concept. Unsuspecting individuals get fooled by unscrupulous investors who promise them extraordinary returns in exchange for their money. Now let us move on to how does the pyramid stumbles. Pyramid schemes are viable as the lowest levels remain wider than the upper ones. But once the lowest levels shrink, the entire structure collapses. By nature of exponential math, it is just plain impossible for pyramids to sustain forever, and somewhere in the chain, people will invariably lose their money. Interestingly, even high-level early adopters may lose their money near the end due to conditions that delay their payments from underlings, which often requires waiting periods. The bottom line is pyramid schemes are illegal in many countries. The model of profiting by using the network effect often traps individuals into recruiting their acquaintances, which can feel slimy for everyone involved and can ultimately strain relationships. Investors should exercise caution with such schemes or simply avoid them altogether. Now we have the tips for avoiding pyramid schemes. Be wary of opportunities to invest your money in franchise or that require you to bring in subsequent investors to increase your profit or recoup your initial investment. Second, independently verify the legitimacy of any franchise or investment before you invest. Here is how you protect yourself. First, be skeptical. If someone tries to sell you on an investment that has huge or immediate returns for little or no risk, it could well involve some sort of fraud. Next, be suspicious of unsolicited offers. Someone might contact you unexpectedly, perhaps inviting you to an investment seminar is often a red flag. Next, check out the seller. Research a broker, financial advisor, brokerage company, and investment advisor firm using the Financial Industry Regulatory Authority. Verify if the investment is registered under the Securities and Exchange Commission. Next, understand the investment. Never put money on an investment you don't fully understand. The bottom line is, it is vital that you know whom you are dealing with and that you understand any investment before handling over your money. Sure, you may miss out an opportunity of a lifetime, but probably not. Like the old adage says, if it sounds too good to be true, it probably is. So that's all from my report on economic crimes. Thank you.